Hello everyone, welcome to this episode of Investment Strategy with Exchange Traded Fund or ETF. Today we are going to discuss what are the investment strategy we can take to protect our portfolio from an upcoming market volatility or recession or a correction. As you know, US stock market is currently running one of the longest bull run, and most of the experts are predicting a recession sometime in the near future. So we'll discuss what are the sectors we can invest so that we can try to minimize the market volatility effect. So before starting, just a quick disclaimer, this video is only for education and entertainment purpose. I'm not a certified financial planner. So before you make any decision, please do your own research or consult with a financial planner. Okay, so let's go to the next uh, slide where we'll see how the market volatility can affect our stock performance. So here is an S&P 500, as you can see, one of the historical chart. So around 2002 time frame, we had a dot-com bubble, right? So the market dropped almost like 30 to 40%. And the next crisis was the mortgage crisis or housing bubble, as all of you familiar. Market then drop again around 30 to 40%. So as you can see, nobody really knows when the market crisis can come and shrink your portfolio by 20, 30, or 40%, right? Because these two crashes happened quite in a close time period, in like 10-year time period it happened, and now we have another 10 year of market expansion, so nobody really knows. So in this kind of scenario, how we can protect our portfolio or reduce the effect? So one of the things we need to be careful about when investing, make a good I would say distribution between cyclical and non-cyclical sector. So cyclical sector means they usually correlate very well with the market conditions. So if market drops, they drop. If market rise, they rise. For an example, financial, real estate, information technology, and energy, right? So if S&P 500 drops 30%, most probably they will drop 30% or even more than that because they are so sensitive to the market. But some of the non-cyclical sector like utilities or consumer staple, they are not so much affected by the market. uh, the reason is this: people are always going to need them because those are the necessities. So even market drops, we are still going our light open, our we need water or gas, right, to run the household. Same thing for consumer staple. We need to still buy food, clothes, and so on. And another good side of consumer staples and utilities is that usually they pay a higher dividend. So even the market drops, your portfolio drops by 30%, you are still going to get 2, 3, or 4% dividend every quarter coming to your portfolio, right? So you're still generating cash uh, compared to other sector where basically you are depending on the growth of the stock. Another thing, the best part of those sectors are that they are low volatile. So usually their price don't drop that much as the S&P 500 or all those cyclical sectors. So let's look at some numbers, historical number, and see how these things uh, played out. So here is the best and worst time table from 1980 to 2015. So we'll see what is the annual average and what was the best performance each sector in this long period of time and what the worst. So as you can see, the consumer staples had the best 26% return in a single year, and the worst was only minus 15. So even the market drop, if you look at other sector, for example, consumer discretionary like luxury goods, vacation, and those, or you can see energy, financial index in its worst time, it lost 55% of its value. So in case of a recession, you see our loss will be much more less compared to other sectors. Same thing for utilities. Best was 29, which is not very good compared to many other sectors. For an example, information technology was 61% best gain. But then again, when market dropped, it also lost 43%. And it is worst was minus 29. So as you can see, overall consumer staple is a very stable sector, where it has a good overall return, 10% in the long term. And then if you have a big portfolio and you are say close to retirement, or you need this money for your day-to-day expense from the stock market income, consumer staple seems like a very good and reliable industry sector. Same thing for utilities. It doesn't drop that much. But another interesting thing is that if you consider in the long term, their actually return is not a very bad. It's 10% almost here, 9%. Is better than many other industries compared, say, like energy, financial sector, um, or materials or real estate, right? So this is one good thing about those two sectors are that they are gain and loss moderate. So in the overall, we are good. And here is an average return and the volatility index. So consumer staple, as you can see, in the long run, their average return is 13.3% between a period of 1963 to 2013, and volatility is much lower compared to other sectors. So the reason of a very good average return of these two sectors is that if you think about 20, 30 years time period, they usually don't lose much value compared to other sectors. So when a sector, say like financial sector, loses 60%, it takes long term to come back to its original point after recovering 60%, right? So that's why their overall uh, return is quite close or maybe lower than consumer staple and utilities. So how you can get some exposure to this sector? So here are three ETF I like for investing in consumer staple sector. So first one is Vanguard Consumer Staple ETF, ticker symbol VDC. Consumer Staple Select Selector SPDR Fund XLP, and iShare Global Consumer Staple ETF KXI. So now we'll see how these three ETF compared with each other. They're actually quite close to each other in terms of performance. All of them have around 2.5 to 3.5% dividend yield. So the way you can look at or compare them pretty easily, one of my favorite tool is Vanguard ETF comparison tool. So here I put all three consumer staple ETFs side by side, and expense ratio, they are not very expensive, 0.10% and 0.13. iShare, I believe, is something similar, so you might have a look. Here are the current price of each of them and average annual performance. So this is one of my favorite areas. So I always like to look at a long-term perspective. So as you can see in 10 year, all of them are giving around 12% to 10% return, which is quite good. And here I have only yield for Vanguard Consumer Staple, but you might also search for SPDR fund and iShare fund. I believe they are quite close. And if I like to see about the holdings, so these are the main largest 10 companies they are currently investing. And as you can see, they are kind of all same. Procter and Gamble, Coca-Cola, Pepsi. So these two are mostly US companies, but in iShare there are also some global uh, exposure like Nestle, Unilever, and Diageo PLC. So that's good to have some international exposure. And here are some more statistical information. So another thing I look usually is price to earning ratio. So all are kind of in the same, range, which is little expensive, but then the market is also overall very expensive. And earning growth rate, one of the thing I like about iShare is that 9.6%. So they're growing pretty much higher rate compared to these two. So you might further look into this. And here are the sector exposure for each of them. So as you can see, it's a consumer staple. So almost all of his equities are in consumer staple. Our next sector is utility sector ETF. So here are three other fund I think are good choice. Vanguard Utilities ETF, Fidelity's MSCI Utilities ETF, and iShare US Utilities ETF, right? So you can go again to Vanguard comparison tool, and here are the tool again. So is 0.10% for Vanguard. I believe other are kind of similar. You might have a look. And let's see what is the return looks like. So in a 10-year return period, uh, Vanguard giving 12%, iShare 12%. I think Fidelity is less than 10-year old. It was created, I think, in 2013, where is this uh, Vanguard and iShare came in around 2004 and 2000. So as you can see, this iShare fund experienced two big market loss in 2002 and 2008 market crash. Still, on average, is giving a return of since inception 7.92, which is quite impressive. So here you can look at the 5-year return as well. So to compare and more return information, and here are the holdings inside those ETF. So as you can see, these actually have the largest US utilities companies like Next, Era, Duke, Dominion, Southern, so on. And if I look at the P ratio, they're all kind of in the same range. And earning growth 6.6 to 8% on average. So overall, I think all of these funds are a good choice if you want to get some exposure to the utilities ETF. And there are many other utilities ETF in the market nowadays. So you might have also look which one have a good performance in the last at least 5 years. So one of the things in this episode, I like to give you an idea about the market volatility and recession. So how to protect them. So I will end with a comment from Mr. Buffett. In the business world, the rear view mirror is always clearer than the windshield. So we really don't know what's going to happen in the future in the stock market, but we know what happened last 10, 15, or 20 or 30 years, right? So that can give us some idea about the future, how the market may look like. So always, but again, past performance doesn't indicate in the future it will work out that way, but at least we get some idea about that, right? So yeah, if you have any question, please leave in the comment box, and thank you for joining. See you again.